Okay, everybody, thanks for joining. Really appreciate it. Welcome back to our Income Summit. This is webinar 3 of 3. We've got Andy Robertson back in the house from Corporation for Social Security Claiming Strategies, along with our very own Maureen Walker, who'll help us with the Q&A and surveys and such. And then, of course, we've got our own Derek Easdon. He is an annuity specialist that will also be able to help you through the process of getting certified with CSSCS, if that is what you would like to do, but then also any other questions related to this topic and annuities and such. So today we're going to talk about retirement optimization sales tools, managing money for income versus growth. And then we're also going to talk a little bit about how you put the knowledge to work, and then how DMI can help with some really excellent marketing tools, training tools, and ongoing support. So we've got a lot to cover today. And again, Andy, can't thank you enough for being here. Andy not only understands Social Security, but also annuities, and he understands the mind of the advisor. So that's why we keep bringing him back. And he has a good way with words, and we just like hearing his voice. So Derek, I'll turn to you first before we hand it off to Andy, if you want to share any thoughts and ideas on the value of what we're doing here.
Yeah, absolutely. Thanks for that. I'm excited to be here today. This is the third of a 3-part series. So if you missed the first two, go back and check those out on our website. I think the first two really set the table well for this third one, right? In the first one, we talked about the opportunity. Really, the agents that I talk to, a lot of times they're looking for ways to maximize each case and to increase their close ratio. This sales process will help you to do that. And I think, one of the things that Andy's talked about in some of those other ones is the importance of being a specialist. And then we also talked about some of the challenges, right? Dollar cost averaging versus dollar cost ravaging, asset allocation versus asset optimization. So, and again, the importance of being a specialist. So pay close attention here. I think this one's going to be great. It's going to help show you the solutions in your process. If this resonates with you, and I think we've heard back from a lot of people that it does, feel free to reach out to me. Scan the QR code right up here. Reach out to me. We'd love to get you enrolled in the next round for CSSCS, and we can do that really easily. And I think we've got the tools and resources to really, as we start to look forward to the holidays, 2024 is right around the corner, and now is the time to start planning for that. And these tools that we're providing you can help you make next year your best year yet. So with that, I'll turn it over to Andy.
Great. Thanks so much, Derek. And I just want to say to Glenn that I'm having a flashback as you were talking and everybody's waving. I feel like I'm on Hollywood Squares. I'm showing my age by saying that, but for those of you that remember Hollywood Squares, I feel like
you made this feel so prestigious. But
yeah, I need to get one of these DMI backgrounds so I feel like I fit in.
Well, we got to work out the prize money thing. I'm not sure.
Yeah, exactly. So. Well, let me see if I can. I think you need to just quickly make me the host, Glenn, and I can share my presentation.
Hey, and by the way, everybody, please use the Q&A and chat functions. So, we'll try to answer questions as quickly as possible.
Maureen was pointing at those earlier at the bottom, but
all right, there you go, Andy.
Great, thanks, Glenn. So,
tear it up.
So, we've talked a lot in these last couple of presentations, and as Derek said, we covered the challenge, and then the opportunity, and then we covered the opportunity and the challenges, and now we're going to talk about really becoming that retirement income specialist. But the question everybody always has about anything that you might be considering as a move or a change is, why would you do this? So I always remember this quote by this bank robber, Willie Sutton. They asked him, I think it was back in the 1930s, he got caught, and they asked him, Willie, why do you rob banks? And he said, well, because that's where the money is. And why do you want to be a retirement income specialist? Because that's where the money is, right? Ultimately, that's where all the money is. As Derek said, you get bigger tickets, increase your closing ratio. You get not only income assets, you get growth assets. I mean, it's just a tremendous opportunity. And if you can really set yourself apart from the competition as a specialist, it'll put you in a position in your marketplace where you can drive results like you've never seen before. So during our time together today, if I can get this thing to move for me here. Got to use these buttons at the bottom. Here we go. We're going to talk about a couple of things. So it always starts with education. From my perspective, if you want to be an income specialist, it always starts with education. It starts with your education, educating you and getting you comfortable with all the pieces and parts we've talked about, and then you educating your client to ultimately create the opportunities you're looking for to become their retirement income advisor of choice. So we'll talk about education. Then we'll talk about built to last. How do you build a retirement income plan that can stand the test of time and meet all the challenges that people are going to face? And there are these challenges, as you know, are very unique. The challenges that you face in income are not challenges that you face during the accumulation phase. And that's really what, kind of makes things so much more difficult. So as we've talked about before, kind of from a theme perspective, how the rules of investing change when you move from accumulation income. Then I want to talk a little bit about what I'm calling the power of leverage. So what's the power of leverage in this scenario? Is there the opportunity to generate leverage for your clients and in the end, as a result, build them a better, more fortified retirement income plan for an average 50% less capital? And that's our story on the whole. That's the message that we deliver: better, more fortified plans for an average 50% less capital. And that's important because, according to all the academics, the vast majority of Americans are on pace to be underfunded, right? But when I say it starts with education, the first thing I always want to make sure we're all on the same page about is, what are we accumulating wealth for in these qualified plans? There's a false sense of security, I think, that gets created when somebody receives a statement. They look at their 401k plan online every day, or they get a statement every year, every quarter. We view that as wealth, this accumulated value that they all of a sudden have, but they have it because they don't have something else, right? We talked about this in the first session. They don't have defined benefit plans any longer. And these defined contribution plans, these qualified plans, they've been created to replace what was in the past a guaranteed income stream that your employer provided once you're retired. So while it looks good, right, it gives people the feeling of, having wealth that they maybe otherwise wouldn't have had. At the end of the day, we're not accumulating that wealth for growth. We're not going to take it with us. We're not going to pass it on to the next generation. In fact, as we talked about last time, you're not going to be allowed to if it's in a qualified plan. We're accumulating wealth in these qualified plans for income. So to be clear, while it looks great on paper, you need a lot of money to create income over a 25, 30, 35-year retirement. That's the challenge. And ultimately, what people don't seem to want to recognize, at least emotionally, is it's all income, right? If you've got money in a qualified plan, whether you see it as income or not, or an income asset, I should say, or not, it's all income. And required mandatory minimum distributions are the proof, right? You're going to be required to take distributions when you reach a certain age. And the intent, they need to understand, is to unlock all that tax infestation and get those taxes that have never been paid on that income back out and into the hands of the IRS. So you're not going to be allowed to sit on this capital and treat it as a growth asset, maybe something that becomes a legacy. It's an income asset. And by the way, if you don't have a pension, which most don't, you're going to need it to be an income asset to provide you with any meaningful lifestyle in retirement. But ultimately, from an educational perspective, we have to make sure they understand, whether they like it or not, whether they see it this way or not, it's an income asset. And as such, we've got to start thinking a little bit differently about how we make what I'll call investment decisions once we get ready to or enter into retirement. Because when it comes to income planning, as we've talked about, the rules as we know them change, right? And if you don't understand how the rules change, if you don't manage the risks differently, you go from an experience known as dollar cost averaging during the accumulation phase to very quickly dollar cost averaging. So because the rules of investing change, it's my position that you now need to stop thinking like, a stock investor, a stock buyer, somebody who's investing money with the hopes of getting a tremendous return, and start thinking more like an income person, somebody who needs income. So I'm not investing for growth. I'm investing for income. I'm not a stock buyer. I'm a bond buyer. I'm not a stock investor. I'm a bond buyer. And I use this because I'm trying to help people understand the implications of making the wrong decision and thinking the wrong way in retirement. If you think like a stock investor rather than a bond buyer, then you increase the probability that you're going to experience dollar cost ravaging considerably. You also put yourself in a position where you have to accumulate significantly more wealth, because along with the upside, of course, that you have in the equity markets, you also have an inherent downside, and downsides become really troubling when you're doing systematic distributions, regardless of market performance, as a result of needing income from that portfolio. And again, that leads to dollar cost ravaging. But think about what I'm saying, how the rules of investing change. If we go back and we look at the case study and some of the numbers that we saw early on, I'll just kind of bring it back full circle to you. You'll remember I was really focused on this idea, this case study, where they needed $108,000 of income. So I'll just draw your attention to this income analysis section right here. In the software, they needed $108,000 of income. And we looked at three scenarios: one where they took benefits at full retirement age, one where they took benefits at FRA. But in both the current and the alternative plan, the assumption was any income gap, any income shortfall, they were gonna provide that additional income. They were going to deliver that additional income using an asset allocation approach and taking their retirement savings to do so. So we said if they have an income goal of 108,000 and Social Security is delivering 72, then we needed 36,000 from the capital if they took benefits at full retirement age. If they waited till 70, Social Security would provide 93,118. So they need 16,294 from the assets beginning at 70 going forward, right? And then we looked at the optimized strategy, which also was to take benefits at 70, but instead of using an asset allocation approach, consider using what I call an asset optimization approach, which is the use of an annuity. And you'll remember the impact to the capital requirement was profound, right? They went from, under their plan, underfunded by 300,000. They had $1.2 million. They needed $1.5 million. So if they moved forward with this plan, they were underfunded by 300,000. If they delayed till 70, they went from underfunded to overfunded, to $185,000 of excess capital. And then if they went with the optimized strategy, they actually had $518,000 of excess capital. We were able to say unequivocally at this time, there was $518,000 we did not need for income in order for the plan to be successful. That's an $818,000 swing in the client's favor. And we did that by leveraging Social Security and an annuity. But I want you to think about it differently. Let's pretend we were looking at buying an income solution, and the price for the income solution was the capital required, the $1.5 million, the $1.015 million, or the $681,000. And if we apply this kind of analogy, that let's think more like a bond buyer than a stock investor, think about how this would play out. So if the bond needs to deliver in total $108,000 of income, and you have $1.2 million to work with, and you had three bond options to deliver that. One had a price of $1.5 million, another had a price of $1.015 million, and the third had a price of $681,000. Which one would you be thinking about buying? If I were your advisor, which one would you instruct me to purchase for you? And the reason I say you need to think about this as a bond buyer is because the decision is based upon a fixed income number we're trying to get to, right? Ultimately, if we want to figure out the return on investment, we have to make sure we understand what the return measure is that we're using. In this case, the measure isn't capital appreciation. The measure is income. And because it's income, we want to focus on price, because we know intuitively that obviously if they all provide the same fixed income and the only difference between the three is price, the one with the lowest price tag represents the greatest return on investment. We know that, right? We could substitute bonds for real estate. We could say, let's say I found you three income properties on the same street. They're identical in every way. They have lifetime leases. They're automatically inflation. The money to pay for those leases for life is already there. They're fully secure. The only difference is the price. Which one would you want me to buy? You would say, well, yeah, I want you to buy the one for $681,000. Why would I ever buy a property that's going to deliver $108,000 a year in income for $1.5 million when I can buy one that's going to deliver $108,000 for $681,000. We understand that intuitively. It makes sense. But when it comes to retirement income planning, people can't make this simple decision. A lot of them say, no, I'm going to stay over here because I want to keep all my money in the market. What if the market goes up? Okay, but here's the problem. This isn't a growth strategy. This is an income strategy. We need this income to last for 30 plus years. And the most effective approach is the one that's going to give you the greatest return on investment. Well, the greatest return on investment is measured by looking at the cost versus the income. So think about it this way. The current strategy is $1.5 million. So what they're thinking about doing, they need $1.5 million to accomplish. By the way, they only have $1.2 million. But even if they had the $1.5 million, if it delivered $108,000, the yield would be 7.2. Under the optimized strategy, we can deliver the result they're looking for $681,477. That's a yield of 15.85. All day long, you would look at this transaction and say, obviously, it's a no-brainer. I'm going with the optimized strategy. And by the way, if I wanted to increase my income, I could take the excess capital and invest that for income and increase the income by another. I think the excess capital here is $500-something thousand. I could increase my income by, another 80%, right? So it makes sense when we look at it through the appropriate lens, but it seems like nobody's able to help people do that successfully. So as a result, they take on all that inherent risk that the market has to offer in hopes that they're going to get some kind of result that, frankly, we've never seen. We don't see the market performing that way. More importantly, they're going to have to invest the money very conservatively because they can't afford the volatility that you see in a pure equity play while systematically divesting to take income, right? So the upside is limited simply by the strategy alone. Never mind the fact that you're systematically divesting every month of every year for the rest of your life. So when you look at it this way, you start to recognize that I make better decisions from a recommendation perspective if I recognize that what I'm focused on is income. And the measure that I should be using for determining whether or not I'm getting the appropriate result for my client is the yield, not the future possibility that I could have 10 times what I started with, which is highly unlikely given I'm 50%. Or in this case, I think it was 25% underfunded to begin with. Now, the only driving factor that I know of from talking to people about this virtually all day, every day, is this idea that they want to have their cake and eat it too. That they think by keeping all their money in the market, in spite of the fact that they're underfunded using a good, credible approach by 25%, that somehow, some way, the market could deliver a performance, even though we're going to be in a balanced portfolio, right? It could somehow deliver a performance we haven't seen in 30 years, a performance that would ultimately overcome a 25% capital deficit while delivering income, increasing that income to combat inflation every year, and doing it for 30 years. Yeah, like I've said before, is it possible? Sure, it's possible. Is it probable? Yeah, it's not probable, right? And we know better. We know intuitively to rely on probabilities when making important life decisions, not possibilities. And I prove that all the time simply by saying, if you lived your life based upon possibilities, you'd never leave the house, right? So we all leave the house every day. We go to work, we go to the grocery store, we get on airplanes. We do all kinds of things that if we lived in the realm of possibilities, would be crazy to do because, it's possible we could get hit by a bus or by lightning or, attacked by somebody unexpectedly. But those things are highly improbable. So we go about our business and don't worry about those things. But when it comes to retirement investing, we focus on possibilities versus probabilities. And of course, if you really thought that was a reasonable approach, then why wouldn't we just take all the money and put it into lottery tickets, right? Go buy Powerball. Look at the numbers it could deliver. I mean, if you believe in possibilities, that's as likely to work out probably as this is. So why not take that risk? But if you truly want to have your cake and eat it too, nothing is going to put you in the greatest position possible to make that a reality than the optimized strategy, right? Because not only are we delivering the income plan on a fully guaranteed, fully inflation adjusted, and highly tax efficient basis for $681,000. But as a result of knowing exactly how much we have to commit today to make that a success, we also know we have $518,000 we can invest for growth, and we can invest it for that purpose alone. Now, we might want to divest that and move it into Roth or other things, but the point is, if we have this $518,000 and grow to just 5%, look at the future value in 10, 20, and 30 years. So not only can you have your cake, right, your income, and have it with a high probability of success, 100% guaranteed, 100% inflation adjusted, low tax, and a higher survivor benefit, but you or your spouse, if they outlast you, or your children will also get the future value of this $518,000. So if that's the motivator, then all the more reason why you want to think like a buyer rather than an investor when it comes to income, because it's going to free up today capital you can invest for the balance of your life in a more aggressive way. So people will talk to me and they'll say, why are you so fixated on Social Security as, kind of the cornerstone of the planning process? You don't really get paid to give Social Security advice. And it's an interesting time to have this discussion, right? Because just a couple of weeks ago, we had kind of the resurfacing of the whole fiduciary discussion. And the focal point of the fiduciary discussion has always been on price. What do you charge? What do you charge? How much are people paying? And this idea that maybe some products should be out of bounds simply because of how you get paid. Well, is it right for you to ignore, arguably, what I call the single biggest retirement income asset your clients own? And they do own it, right? They own the rights to it. They own the rights to the income. Is it right to ignore it simply because you don't get paid? I struggle with this idea that I'm going to ignore Social Security because I don't get paid and it's not an asset I can get paid on, but I need to ignore other products that can be really valuable to my clients because of how I get paid. Well, is it about compensation or isn't it about compensation? To me, it's about the client. It's about what's in the best interest of the client, right? What's the ethical thing to do? And ultimately, this is the one source of income for a fact is paid for life. It continued for the life of the surviving spouse. It's automatically inflation adjusted. I'm going to talk about that in a minute. It's highly tax efficient. And unlike some of the banks we learned in 2008 were too big to fail, this is backed by a government promise. This is why Social Security is the cornerstone of any retirement income plan. And by the way, for the people who question, well, what if it's not going to be here? Here's what I would say. For the generation of people you're talking to today, this is not a reasonable or rational discussion. My answer when people start talking to me about what if it's going to be here, what if it's not going to be here, I ask them a very simple question. If we assume Social Security is not going to be here for you, how long is this retirement planning discussion really going to last? Because if you're underfunded already, counting Social Security is part of the pie, how do you become overfunded by assuming it's not going to be there? Any issues Social Security has will have to be addressed by the next generation. This generation has to move forward with the assumption that it will be there. I believe for a whole host of reasons, which we can talk about another time, it will be there. But not only that, it's a very dynamic retirement income planning tool that, again, takes a lot of pressure off the capital over time and puts the client in a better position when you leverage it successfully. So
Excuse me, Andy?
Yeah.
Quick question, and you can get to this at another point. I think we passed it. When you were showing your case study chart, we did have a question. Does the 1.5 million include any gains during distribution?
Yes. So the initial safe it's a long story, but initial safe withdrawal rates are done through Monte Carlo simulations, and you use assumptions around returns. So in one of the earlier of these two, I covered both that. I talked about the equity assumptions and I talked about the fixed income assumptions. So if you want to direct them back to, it would have been the second session, I go into detail on what those numbers were, but it was roughly 9% for equities and 2.5% for fixed income with a reversion to the mean of 5.5%. We're talking about intermediate bonds over the time frame in question. So they're healthy assumptions. We're not overstating or understating anything to back into a result that we're looking for. These are reasonable. I would argue in some cases maybe overstated. So if anything, the numbers are probably should be lower. The initial safe withdrawal rate should be lower than they are, and as a result, that would deliver a higher capital requirement. But yes, there are performance assumptions baked into the analysis that was conducted to arrive at those numbers.
Thank you.
Okay, you bet. So going back to Social Security and the value it brings from an economics perspective, here's what I can tell you today. Somebody turning 62 today asked Andy Robertson, how much more am I going to get at 70? My answer is very simple. If you opt not to take benefits at 62 and you wait all the way till 70, you're guaranteed to get at least a 76% increase. It cannot be less, but it could be more. What this slide is showing you is that if somebody had a full retirement age of 66 and 8 months and their primary insurance amount was $1,000, it really doesn't matter what the primary insurance amount is. But if they took benefits early, they took them at 65, there's a fractional reduction for every month you take early. The total impact, if you took them at 65, is a permanent lifetime reduction off what it would be at 66 and 8 months of 11.1. If you take them at 64, it's 17.8, 63, 23.3, 62, 23.23, 28.3. So a lot of people think about taking benefits early with the intent of, frankly, saving those checks, building a secondary retirement account, and using that secondary retirement account to match the increase they would have gotten from Social Security had they simply waited. I'll tell you what I tell everybody: sounds good in theory. In practice, it's a really tall order because of the earnings test, which I'm not going to get into today. But more importantly, if I take benefits early and have an FRA of 66 and 8 months, and I'm going to have a permanent reduction of my primary insurance amount of 28.3%. So a lot of people know if I take early, I get a reduction. They also know if they delay, they get an increase off their primary insurance amount. And your PIA is your RIB at FRA, right? So there's a decrease if you take early, an increase if you delay. The increase is equivalent to 8% per year simple. It's only 2.67 in year one because it's only 4 months to get from 66 and 8 months to 67, but it is an 8% increase you accumulate at, but it's a simple interest calculation because they don't apply the delayed retirement credits until you file, so there's no opportunity for compounding. But the point I'm making is, under current formulas, the difference between what you can collect at 62 and what you can get at 70 is just over 76%. That's a guaranteed minimum increase. Cannot be less, but it could be more. Is that powerful? Yeah, it's powerful. If you went back and did the math and said, look, if I saved every penny like clockwork between 62 and 70, what would I have to accumulate to match this 76% increase? And then if I saved every check like clockwork, what would I have to earn on that value to get to the 76%? And the answer is, you'd have to get almost 30% per year in the compounding annual growth rate if you saved every check, which is laughable to think that somebody would even do that. But if you saved every check like clockwork, you'd have to earn just over 28% to actually accumulate enough money to match the 76% increase. We all know how unlikely that is. But more importantly, not only is this increase incredibly powerful, but as I've said multiple times, that's a minimum increase, cannot be less, but it could be more. How could it be more? Very simply, it's more. It could be more because once you reach that first year of entitlement, age 62, whether you're collecting benefits or not, every year that a cost of living adjustment is declared, your primary insurance amount is adjusted on a compounded basis to account for that cost of living adjustment. So just recently, we've had a couple pretty stellar cost of living adjustments that have come out, right? And we're going to update this for this year's declared increase. But we've had a lot of advisors call us and ask, hey, do my clients need to file now to get the 8.7? You get the 8.7 whether you filed or not, right? It has a direct impact on your primary insurance amount. So the point is, the only way you would get a 76% increase is if every year between your age 62 and your age 70, the cost of living that was declared, cost of living adjustment that was declared was zero. Well, they've been declaring them automatically since 1975, and there's only been 2 consecutive years where there was a zero. In fact, as I look at this real quickly, there's only been 2 zeros, and they were in 2 there's 3, but there's 2 consecutive years where there's been a zero. You'd have to have the full cycle between 62 and 70 for that to happen. So is it likely? Not likely, guys, right? Not probable. Possible? Yes, not probable. So the point is 76% increase, and that's very difficult to match. Using this idea that I'm going to save benefits and build a secondary retirement account, you have to earn almost 28% to match a 76% increase. What are the chances you're going to match the increase after COLAs? Forget it. I mean, it's crazy. But more importantly, after every 8-year cycle, we look at this and say, all right, if I attained age 62 on January 1st, 2014, and said, Andy, what am I going to get at 70? Of course, I'm going to say you're going to get 76% more, cannot be less, but it could be more. Now, January 1st, 2023, you've got that last declared COLA. What was the actual increase? 123%. So again, highly unlikely that you could match a 76% increase, not even worth the discussion to suggest that somehow you could match 123% increase. Never mind the fact that you're going to be contending with the earnings test every year between 62 and FRA. So the point I make in sharing all this with you is the reason we focus on Social Security is a catalyst for delivering guaranteed lifetime income on an inflation-adjusted basis, and it's virtually unmatchable if you try to do it from your own. If you try to create a retirement income account that could kind of compete with it, it's just not. Sounds good in theory, but it's not likely that you would be successful in doing that. And by the way, even if you were, let's assume you were, if you got 28% like clockwork, all you would have done was match the increase you would have gotten had you simply waited. And think about all the risk you would have to expose your clients to between 62 and 70 to actually achieve that goal. And how much better off do you end up? You don't end up any better off at all. Now, in addition to that, by the time the earlies or the laters, this is the imaginary couple I talked about early on, by the time they reach age 70, whether they retired at 66 and 8 months and took benefits at 66 and 8 months, that's the earlies, or they retired at 66 and 8 months and took benefits at 70, that's the laters. By the time they're 70, the inflation adjusted income goal is 119,212, up from 108. So not only are we delivering the plan for significantly less capital, but look what happens from a tax perspective here. So obviously for waiting, they have significantly more guaranteed income thanks to delayed retirement credits, but they have 44% less taxable income. So in addition to everything else we've talked about, not only is Social Security a catalyst for preserving your capital because it reduces the amount of capital you have to commit to the plan in the first place, but it delivers a plan more heavily weighted. Social Security delivers a much more tax efficient overall retirement income stream for the client. Maureen, are you on because you have another question?
We do. So Andy, does one's mortality change the answers?
Yes, absolutely. So in the software, we pick the number of years we need the plan to last, which is reflective of the mortality, right? So I'm using 30 years. Of course, you could have a couple come in and they could say, well, I'm ill and I'm only going to be here for 5 years or 10 years. You change that time horizon, it changes the initial safe withdrawal rate that we use to back into the capital requirement. So mortality does play a role. Now, when you're dealing with a couple, right? When you're dealing with a married couple, you're dealing with two mortalities. So the likelihood that it's going to be a shorter period of time is much lower unless they're both ill, right? But yes, mortality is one of the independent variables that you can control in the analysis, and it will reflect in the capital requirement. The lower the time frame, the shorter the mortality, the larger the initial safe withdrawal rate, so the smaller the capital requirement. But in my analysis here and the assumptions that I'm working through, which again, we went through in the earlier presentation, I'm basing it on 30 years. So going back to the tax piece, under the earlies, they have $119,000 of income, of which almost $76,000 of it will be considered taxable. I'm not going to go through the breakdown of how we got here. I'll talk about how you can learn that yourselves in the end, but you'll just have to trust me that this would be the total taxable income if the makeup of your income were $79,475 in Social Security and $39,737 in a fully taxable IRA distribution. But even this, most would argue, is more tax efficient than people would realize. 119, only 76,000 is taxable. Well, how about the laters? They have almost $103,000 in guaranteed income and $119,000 of total income, and only $42,485 is taxable. This blows people away because it's inconsistent with what they think they know about Social Security. They know about these thresholds, which I'll talk about in a minute, but the disconnect is that the thresholds are not applied to your total income and they're not applied to your Social Security income. They're applied to what's known as your provisional income, which I'll hear in a second. But what I really want you to think about, again, why is Social Security one of the focal points of what we talk about, is not only, again, is it driving down the capital requirement, increasing the plan's ability to combat the erosive effects of inflation and longevity, but it's also going to provide much more tax efficiency. So this is just a simple calculator I created, but what you see here is this is the earlies and this is the laters. By the time they're 70, I just took the numbers we just went through and I plugged it in here. The remaining time, so I'm assuming they retired at 67 with a 30-year time horizon. By the time they're 70, these are their numbers. So we have $119,212 of income at 70, right? And then we have the makeup of the income. Here's what's coming from Social Security. Here's what's coming from the annuity, not the annuity, from the IRA distribution. And then over here, here's what's coming from Social Security. Here's what's coming from the IRA distribution. And the total taxable income, again, $75,890 for the earliest, $42,484 for the laters. Laters, that's $33,406 less taxable income year one. Over 27 years, if that remained consistent, which from my experience, it'll actually become greater as the Social Security portion increases thanks to COLAs, but $33,406 over 27 years means they have almost $902,000 less taxable income over that time frame. No one's talking about the tax efficiencies afforded Social Security. Everybody talks about this concept of break even. Okay, great. We can talk about break even, but if you consider the implications of the tax savings in that part of your analysis, and I know the answer is no, because nobody even understands how Social Security is taxed. So again, when you make yourself a specialist all this stuff becomes a critical part of what you do, becomes a critical part of the work that you do, and it also is very effective at differentiating you from the competition. It is Hollywood Squares. Maureen's back. What do we got?
Andy, how does an agent or an advisor have access to this calculator? Are they able to access this and input numbers?
Yes. Yep. They have access to this through the CSS platform, which we'll talk about when I wrap up here. So I'm almost there, but that's a good question. I like to hear that. So hopefully this resonates with you guys, but this isn't really the focal point of what we're doing. We're focused on how do we build a better, more fortified plan for less capital. But the fact that we can also, in many instances, deliver the plan on a more tax efficient basis and highlight for them just what this means. I think we can all agree that somehow, some way, the federal government has to find a way to increase its annual revenue. And the only way it has to do that is to increase taxes. So regardless of what your feelings may be politically, I think it's unusual that somebody would think that taxes are going to hold, right, given the situation we're in from a debt perspective. So we've got to think about taxes today and prepare for the worst tomorrow. This is one of the added benefits of leveraging Social Security and being a retirement income specialist. So going back to provisional income, where the real disconnect is on these thresholds. So most people are aware that if they have between $32,000 and $44,000 of income, right? And usually they think it's Social Security income, and they file a tax return as a married couple filing jointly. If they have between 32 and 44 of Social Security income, then 50% of their benefits taxed. If they have more than 44,000, then 85% of their benefits taxed. So two things: one, it's not a flat tax; it's a progressive tax, so it's up to 50 and up to 85, right? But it's not based upon your total income. It's not based upon your Social Security income. It's based upon your provisional income. So these thresholds are applied to your provisional income, which really has two parts. Under the provisional income formula, which is used to determine your provisional income value, 100% of your modified adjusted gross income is counted dollar for dollar. So modified adjusted gross income is just a fancy way of saying all your earned, unearned, and even tax dividend income is captioned under modified adjusted gross. It's counted at 100% under provisional income. Here's where the magic happens. Only 50% of your Social Security benefit is counted under provisional income. So now you can see why the laters have a much more tax efficient plan, right? Because $100 and some odd $1,000 of their income is coming from Social Security, and that's only counted at 50%. They had $16,294, and what we're assuming is a fully taxable IRA distribution. Their provisional income number is smaller than the earlies, and in the end, it results in a significantly lower amount of taxable, what's considered taxable income. Now, remember, all these numbers are prior to applying any kind of deduction. Now, the reality is, when you file your return for 2023, if you're a married couple filing jointly, you're both over age 65, you're entitled to at least the standard deduction of $30,700. So you go back, the laters had a total taxable income on almost $100 of gross income. Before deductions, they had a total taxable income of just over $42,000. When you apply the standard deduction, which everybody's entitled to, right? I don't have to be a CPA to state a fact. Is it possible they could be entitled to more deductions if they itemize? Yes, and they should absolutely seek out the advice of a tax professional. But I can say unequivocally, at a minimum, they can take $30,700 off the top. And what that would mean is they'd have roughly $11,700 of total taxable income on $120,000, just shy of $120,000 of gross income. So they owe roughly at $11,700 to be in a 10% marginal tax rate. They'd owe roughly $100 a month on just about $10,000 a month in income. I'd say that's pretty darn tax efficient. And by the way, we didn't have to do any rough conversions. We didn't have to go through any kind of, gymnastics to get them to a tax efficient income stream. We simply needed to leverage Social Security a little bit differently. So hopefully you're seeing how, when you bring it all together, the economic value Social Security can bring to the process, and how it can be one of the main drivers in delivering a much more cost efficient plan, right? So I'll go back to where we started earlier when we did the first two presentations. So the capital available, whether they're the earlies or the laters, or I'm calling them the optimized now, is $1.2 million. The capital required for the earlies plan, which was to retire at FRA and take benefits at FRA, is $1.5 million. We knew at that point, if they went forward, which they could, they're underfunded by 300,000. For the laters, if they optimize using an annuity rather than asset allocation approach, for those of you who saw that, understand the total capital requirement drops from 1.1 million to 648,000. They go from, in the early scenario, underfunded by $300,000, right, to only needing $648,000. So now they're overfunded by called 552. So that's an almost $852,000 swing in the client's favor. Underfunded by 300 to overfunded by $552,000. And how did we do it? We didn't get lucky. We didn't rely on getting the right sequence of returns or buying the right stocks or the right bonds, or I used to say the right crypto. We didn't have to get lucky at all. We were just better at leveraging all the tools in the toolbox and not ignoring something simply because of how we thought we got paid. All our people get paid for giving this kind of advice because they get all the assets when you deliver the kind of plans that we deliver. So ultimately, how did we get there? How did we get to a point where they went from underfunded by $300,000 to overfunded by $550,000? We did it through the power of leverage, right? And by definition, leverage in this context is using something to its maximum advantage, right? And what are we using? We're using two things. We're using Social Security and we're using an annuity. And both of them operate off the same premise, right? The same premise of leverage. And it's really simple. Social Security and annuities, how do they differ from capital markets instruments? Social Security and annuities focus on the risk associated with lives, and asset allocation focuses on the risks associated with the markets. And frankly, the actuarial world has a much stronger handle on risks associated with lives and how long people will live than anybody has on the markets. The markets are as speculative as you can get. I don't care what anybody says. You'll never convince me otherwise. It's pure speculation. And by the way, if we could predict, none of us would have to do anything but manage our own money, would be retired overnight through our ability to time the markets and buy and sell in a way that would make us unprecedented returns. But that isn't the reality. So Social Security and annuities rely on managing the risks around lives. Asset allocation relies on being able to manage the risk around markets. And as a result, you need significantly more capital to deliver the income using capital markets than you do using lives. And it's simply because of the handle that actuaries have on the ability to understand the implications of lives, right? So what they're focused on is how many lives are going to live, how many people are going to live X number of years versus what's the market going to do today, tomorrow, next week, next month, next year. And it shows up. Their ability to manage that, understand that risk, shows up in the dollars, right? So you'll remember, again, those who were here originally, if we look at how much capital we have to commit. So under the current plan, if we need $36,000 a year, increased by 2.5% per year to combat inflation over 30 years, the aggregate amount of income that plan is expected to deliver is just shy of $1.6 million. The amount of capital we're advised to have on hand to meet our objectives were 30 years at a 95% probability of success, is $1.5 million. We need 95 cents of every dollar on hand to meet our objectives. Under the optimized plan, beginning at age 70, they need $16,294. For the next 26.33 years, inflated at 2.5%, the aggregate amount of income that we're going to have to provide under the optimized plan is $596,911. The amount of capital we had to commit to the product, the performance-based solution that I introduced prior, is $237,955. We're able to deliver the income for 40 cents on the dollar as a capital commitment versus 95. This is the power of leverage. I talked about this in the past and said, this is the epitome of self-insuring. This is leveraging insurance, right? And the difference is simply, what is the risk, right, that we're exposed to? So over here, we're managing the risk of lives. Over here, we're managing the risks of the market. The markets are far more volatile and difficult to predict. So we have to have more than twice as much capital to guard against the risks that we're exposed to than we need if we use the leverage approach offered by Social Security combined with an annuity. Make no mistake about it, Social Security is run by actuaries. It is just arguably the largest annuity in the world, but it is built on the same premise as an annuity. They use the same actuarial science to build its pricing model. So ultimately, asset allocation provides no guarantees. There are no guarantees when it comes to asset allocation. We can predict, but we cannot guarantee. under the asset optimization plan, where we're combining the power of Social Security with the ability of a lifetime income product, a guaranteed lifetime income solution from a multi-billion-dollar financial institution. I would argue all day that the asset optimization strategy is all guarantees. So ultimately, what you've seen over the course of these 3 sessions is a tremendous opportunity to be a specialist, why you want to be a specialist, what the challenges are, what the solutions are. Now, the next question is, where do we go from here? So step 1, as I said earlier, it begins with education. You need to start by getting yourself educated on Social Security. Social Security is the most dynamic tool in the retirement income planning toolbox. And through my partnership with DMI, you can access our program called Certified in Social Security Claiming Strategies. We've had thousands of financial advisors around the country go through this course and use it as a differentiator in their practice. Glenn, Maureen, and the team, Derek, can tell you how you can go about accessing it through that partnership that we have with DMI. Then once you're educated, you need to get out there and bring your message to the market. Glenn, I'll kick it back to you to talk about that and how DMI really sets the stage for what you need to do to really get this thing off the ground and market yourself as a go-to retirement income planner in your market. So hopefully that hit the mark, and I'm happy to answer any questions once we're done. Thank you.
Thanks so much, Andy. I appreciate it. Yeah, so we've got a lot of people asking, well, how do I get started? And, I would first say that there's nobody putting together the knowledge that we put together in this program in quite this way. And I just kind of want to run through what that is here. So this is a web page that Derek can take you to. So contact Derek to get access to this page. This is the page that can launch you into the CSSCS program and get you started with, becoming a specialist and getting that differentiation in your community. So we call it the Social Security Optimization Program, but really it could be called the Retirement Income Program, right? And we're all about building better retirement plans for 50% less capital. And to Andy's point, it's more of a guaranteed plan, obviously, right? So, and there's a video here that you might want to check out from Michael Hayflick, who generated over 200 million plus in AUM in just only 6 years. And he adheres to this program. This is a part of his workflow. This is a part of his practice. It's changed the way he runs his business. And he finds that it's also much less stressful because of the guarantees it's offering his clients. So he's not getting those nasty phone calls that others that don't operate in this way as a specialist get. So it's something to think about. Your quality of life is going to be improved in a number of ways by getting enrolled in this program. But so to go through some of the benefits, one, we're going to give you a discount because of our relationship with the CSSCS, and you'll receive a certification that you can put in your title. Also access to Social Security experts, including Mr. Andy Robertson here. So we'll literally let you set aside time with Andy, 30, 40, 45 minutes at a time, to go through any concerns or thoughts you might have after you've been through training, you've got your certification. He's always available. We've also got client-approved marketing materials that can help you strike up conversations with clients. One of the pieces that I really like is a questionnaire that we have that asks clients about their current planning or our prospects about their current planning. And then we also have a complete campaign that gives you a DIY promotion around a webinar that you can do. We give you the scripted PowerPoint so you can discuss this intelligently, but all the email pieces, the invitations, the tactics, the follow-up strategy, everything you need to run that webinar and generate leads and opportunity from that complete campaign. And then also for those that, well, one, you got to get licensed with DMI to utilize all of this that we're talking about, to get the discount with CSSCS. And then there's also potential reimbursements for the class fees. Further, well, here's the cost. So it's normally an $800 cost you're getting for $524.99. And then we also discount the ongoing annual price, which I think comes to like $150 or so with our discount. So it's a good deal. I myself am a CSSCS certified, not advisor, but I'm just CSSCS certified. And I've got my book that I studied back in 2022, but you can also get the books online. And so let me show you how easy this is to get started real quick. So if you want to get CSSCS registered, you just click on that button on the website. It's going to show your discount here, populates your information and the shipping information so we can send you your books. And then once you get access, I'll just show you what the dashboard looks like. You'll see the active course. You can start your course. You can also get access to a digital version of the book that I just showed you. And then this is going to give you updates on completed courses. Somebody was asking about calculators. So we've got the WEP calculator, taxability calculator, RMD tax analyzer, CAGR calculator, compares the economic value of income annuities with safe withdrawal rates. There's so much that this program offers. That's just the beginning, and I just didn't want to take too much time, but I did want to outline for you guys what the process is. And our next CSSCS class, the reason why I'm being so emphatic about this is that the next class is on December 6th. So if you want to get started and you want to kick off the new year with kind of some new perspective and start getting a different type of visibility on your business from your clients and future clients or prospects, this is a great way to go. But you want to get started right away because you want to study your books before December 6th. Then that December 6th class is like 3 hours or so. And then there's a follow-up class on December 7th to talk about the Athene Retirement Optimizer, which hones in on focusing on how you make those retirement income calculations. So Maureen and Derek, I don't know if I missed anything there that I should cover. Derek, did I miss anything, or do you want to add anything?
No, I think you covered a lot of it. Again, just reach out. We'd love to get you enrolled for that next that next course in early December. So feel free to reach out to me.
Maureen, any other thoughts there that we might have missed?
Yes, we do have one final question, Andy, and it's a little bit long with a lot of numbers in there. I'll read it to you, but you may want to look at the screen as well. So for clients that would be willing to wait until age 70 to draw Social Security, but don't wish to retire on an income of $108,000 at age 66, do you recommend they tap into the excess $500,000 for the years until age 70? So I think the question is really about bridge income, if I'm reading it correctly.
Yeah. So again, there's so much to cover, and as you know, Maureen, we actually include that in the total capital requirement. So what we do, but they don't have to tap into the excess capital. We've accounted for the bridge capital in our total capital calculation. So in the optimized scenario, we're saying they retired FRA. They don't take Social Security benefits. They have $108,000 income need from FRA until 70. So we calculate what would that equal if they were going to fully fund that out of their own pocket on an inflation-adjusted basis. We add that number to the $237,000 annuity premium, and that's how we ended up at $600 and some odd thousand is the total capital requirement. So the $550,000 that I mentioned as excess capital is free to be used for something entirely different, because we've accounted for that bridge capital that you're referencing in your question. So great question. I know because we didn't get into that level of detail, it wasn't clear that I actually accounted for that, but it is in there. If you go back to the presentation, or if you have a chance to look at the original session, we kind of dug into that in a little more detail, but we call that the bridge capital. So bridge capital calculates the amount of capital they'll need to utilize to supplement their retirement income need between when the first spouse retires and when the second spouse takes benefits. But we leave nothing to the imagination. We account for everything because we recognize that those are the things that people are going to zero in on. And we want you to know that all of that is there. And we do have on December 7th, a software demo scheduled, Maureen, that I believe you put together. And we'll cover that again in that session in more detail so you all can see it. But great question. Thank you very much for that question.
And we have some great case studies that help to visualize that, show some calculations around that. So, but yeah, that's an important part of the CSSCS study and the certification. So we look forward to seeing as many of you as possible at that next certification. Again, reach out to Derek. His contact information is right here. Can get you cranking. Derek Easdon, 781-919-2344. His email's not on here. It's deasdon@dmi.com. Again, deasdon@dmi.com. He'll look forward to talking to you. All right, guys. Good stuff.
Awesome.
Appreciate the 4 squares today.
Yeah.
Thank you,
guys.
everybody.
Thanks, everyone. Have a great week.
Thanks, everybody.
Bye-bye.